Welcome back, accounting boffins, right? Remember, we're busy with the balance sheet, also known as the statement of financial position, and we're looking at the adjustments and how they impact on the statement of financial position. So remember, when you are doing your adjustments, right? When you are doing your adjustments, these adjustments are impacting on your balance sheet. They're also impacting on your income statement, right? Again, we said, remember the components of your balance sheet. You have your assets. Under assets, you have your three components, namely your non-current assets, you have your financial asset, and then obviously you have your current assets. Okay, so this means therefore that the format of your balance sheet is critical when you are attempting a question on the statement of financial position, namely the balance sheet. Okay, so here we go. The following information appeared in the June bank statement. These must still be taken into account. There's bank charges of 350, interest is debited of 220. There's a direct deposit for the June 2020 rent from M. Moses. The rent was increased by 200 Rand per month from the 1st of April 2020. Okay, now, in terms of my calculations, firstly, I'm given a rent income figure of 35,600. Okay, that's my rental figure that's given to me. There's a direct deposit that I need to take into consideration. And I was told there was an increase in the rental of 200 Rand per month. Let's just verify that information. The rent was increased by 200 Rand per month from the 1st of April 2020. So this is what I do. Step number one, start off with your 35,600, right? And remember, you know that the rent was increased from the 1st of April. So April and May, those 2 months, the increased rental works out to 400 Rand. Got it? Okay? So what do I now do? I now say, fine, take my 35,600 minus the increase of 400, which will give me a figure of 35,200. What am I doing? I'm trying to ascertain what figure should be used as my rent figure, because they only told me that the rent, there was a direct deposit from our tenant, and they told me that the rent was increased by 200 Rand from the 1st of April. So step number one, remove the increase. For how many months? April and May. So 200 Rand per month times 2 will give you the 400. So that's the reason I'm subtracting the 400 to give me my figure of 35,200. Okay, now take that 35,200 and divide it by 11. Why 11? Because you've received rental right up to May. It's the June one that appears as a direct deposit. Okay, let's do that calculation. So here we go. We had 35,600 minus the 400, which was the increase for the 2 months, to give me 35,200. Divide the 35,200 by 11 to give me the rental of 3,200. So this was the rental prior, before the increase. Okay, guys? It was the before the increase. Clear? Now, if that was my amount before the increase, what do I now do? So I've got the figure before the increase. I now add the increase to that amount. Here we go. Take your 3,200, which we've calculated there, plus the 200 increase, meaning that your new rental will therefore be 3,400. That will be the new rental after the increase. Okay, so you can clearly see that you have to calculate what your rental figure was based on the information that was given to you. Okay, so now that we have that figure, let us see how is this going to impact on my balance sheet. Okay, we've got bank charges of 350. We've got that figure. We've got the interest of 220, and we've worked out our direct deposit to be 3,400. Okay, so there's my 3,400 was the direct deposit. Here we go. Your bank figure, obviously you started off with the 5,440, which was my given figure. So here we have the 5,440 as my starting, minus the 350, what was that? My bank charges, minus my interest on overdraft. Okay, now just a bit of information on that one there, on the interest on overdraft. Here it was called the interest that was debited, which is actually your interest on overdraft. Now, bank charges and interest on overdraft are both charges levied by the bank. However, in accounting, and for good reasons, we always keep bank charges as an operating expense and the interest expense as a separate item, because interest expense is not an operating expense. Rather, it is a financing expense, and therefore, notice even in your income statement, it appears as a separate item at the bottom of your statement of comprehensive income. Clear? I hope that is crystal clear to you. So keep your bank charges separate from your interest on overdraft. Okay, but obviously for calculation purposes, all of them are decreasing your bank figure. Therefore, we say 5,440, which was my starting figure, minus the bank charge, minus the interest on overdraft, and plus the 3,400. Clearly you can see that that was your rent amount that was directly deposited into your bank account. So obviously it's going to increase your bank account. So if we take all of that into consideration now, you start off with 5,440 minus 350 minus 220 plus 3,400, and that gives me my new bank figure of 8,270. Okay. What else goes into this note, namely your cash and cash equivalents? It will be your bank, which you've seen there, plus your petty cash, plus your cash float, and another very important figure is what? The fixed deposit. Which one? The fixed deposit. The one maturing within 12 months. Remember, the one that's going to mature within 12 months will be taken out of my fixed deposit under financial assets and will be added to my cash and cash equivalents. So keep this in mind. Whenever you're doing a balance sheet, look for the financial asset, namely the fixed deposit, see which component is maturing within 12 months, take it out of the fixed deposit and include it into your cash and cash equivalents. Right, next one. We have interest on the mortgage loan is capitalized. Let me explain that to you. When they say interest is being capitalized, what does it mean? It means that the interest that is accrued on the loan is added back to the loan. That's what we mean that interest is capitalized. Okay. The loan statement received from Flow Bank gave the following. Your balance at the beginning was 300,000. Your total repayments, including the interest, was 129,000, and your balance at the end was 198,450. Okay. Now, like I always say, whenever you have this information, put it in the form of a T account. It'll make it much clearer and easier for you to understand. Let's do that. Okay, here we go. There's my opening balance of 300,000. Right? Opening balance. There's my bank figure, repayments including my interest. There's my balance at the end of the year. Right. Firstly, let me do my calculation. So we say 198,000 450 plus 129,000 is equal to that, minus the 300,000, which is your opening balance of your loan, right? Will give you a figure, a missing figure of 27,450. Here we go. There's your 27,450 as your interest that has been capitalized. Right. What do you need the 27,450 Rand for? The 27,450 Rand will go to your statement of comprehensive income. Under the bottom section, you'll say there, interest expense. How much? 27,450. Right. We're now in the balance sheet. How do we report in our balance sheet? Very, very important. Look at this last statement here. The capital repayment will remain the same as last year, right? So information, the capital repayment will stay the same. Okay. So this is what we do. You take your 198,450, which is your closing balance. Watch, it's your closing balance, 198,450. Right, now, if you look at your bank payment, you've paid a total of 129,000. Okay, 129,000 was the total amount that you've paid. But included in there was interest of 27,450. So minus 27,450, and this gives you a figure of 101,550. I'm just going to write it here, 101,550. What was the 101,550? So you've paid the bank a total of 129,000. Clearly you can see it, right? Of that, you had interest to the value of 27,450. So therefore, if you subtract the interest, bank minus the interest, it gave you a figure of 101,550, meaning your capital repayment on the loan was 101,550. But now, let me show you another way of checking this out. Okay, watch this. If I take my opening balance of 300,000, right? 300,000 minus my closing balance of 198,450, 198,450, what do you get? What do you get? 101,550, the same amount. So there's two ways of verifying the capital repayment. One, you compare your opening to your closing balance, right? If you have all the information. And number two, you could take your bank figure, your total payments, which has capital plus interest in it, minus your interest to give you your capital repayment. Therefore, now when it comes to my balance sheet, watch this here. It's a 198,450, which was my closing balance. Once again, there let's identify it so you can clearly see it. My closing balance of 198,450 minus the capital repayment, and I showed you how we got that figure. So obviously it will be the 198,450 minus 101,450, and there you have your figure of 97,000 Rand, which is your non-current liability. Right. Now the moment you subtract that from your non-current liability, so in other words, your non-current liability is your loan that has a repayment period of greater than 12 months. The short-term loan must be taken out, and that's exactly what we are doing. We're removing the short-term loan from our non-current liability. How much are we removing? 101,450. And what are we doing to it? We're replacing it under current liabilities short-term loan, namely 101,450. What are you doing here? You're explaining to the reader of the balance sheet that yes, we've got a non-current liability. The amount is 198,450, but in next year, within 12 months, you'll have to make a repayment of 101,450. And that then moves from being your non-current liability to your short-term loan. That means payable within 12 months. That's your current portion of your loan, also known as the short-term loan. Clear, guys? So whenever you're dealing with a loan, remember the separation. Separate your non-current liability from it. Remove the short-term loan, that portion of the loan that's repayable within 12 months. Okay. So we've dealt with the bank charges, we've dealt with the interest, we've dealt with the direct deposit. Finally, we are told there's a fixed deposit of 100,000. 30% of the fixed deposit will mature within the next year. What are we going to do? Watch. Under my financial asset, I've got my fixed deposit of 100,000 minus the 30,000 that will mature. Therefore, my financial asset is now 70,000. Where do I place the 30,000? Under cash and cash equivalents. I say fixed deposit maturing within 12 months, and therefore I have that 30,000. Notice that whatever you subtract there has to be the same figure. So with the fixed deposit as well, what do? We remove the portion that's maturing within 12 months. We take it out of the financial asset and we place it where? Under cash and cash equivalents. Telling the reader of the balance sheet, within 12 months, you will have access to 30,000 Rand because it will no longer, it will mature and the funds will flow into my bank account and I will have access to it. Okay, guys, that's the second segment concluded. What have we done here? We've looked at specific adjustments pertaining to the balance sheet and how you must go about handling it. I'm sure we've piqued your interest and you now want to know more. Stay with us. We'll see you shortly.